What is going on, everyone? Welcome to our Finance Tuesdays. We are on part 5 of the Blueprint to Financial Freedom. And I just want to clarify something I said last week about, getting insurance policies. I said something about auto insurance. Obviously, you need that. If you don't have that, that's not a good idea. I did mention that, and I combined that with the home insurance. I just want to clarify that point. You're already going to have auto insurance while you're getting out of debt, but if you haven't gotten it, make sure you have that coverage, because if you ever get in an accident, anything ever happens, you don't want to be held liable for all that cost. So I just want to clarify that part. So what we're going to talk about today is self-financing a car using the Sacred account. And if you haven't already, make sure you go check out those videos on the Sacred account. So it explains what that concept's all about. And it's a different approach instead of using the bank to get a loan. A lot of times, you go to the dealership, you get your car, you get a loan from the bank, and that's it. Well, if you're doing that, you're really just messing yourself up. And I'm going to tell you why, because it is a product that isn't an asset. It's a liability, right? First and foremost, you're not really gaining anything from that, but there's a way to reverse that process. So what is a Sacred account? It is a life insurance policy. You earn a 3 to 5% dividend when I borrow from it. I only pay 1 to 3% interest. And when I borrow, I'm borrowing to pay off debt. I'm borrowing to invest, or I am borrowing to increase my opportunities in life, whether it's a skill I want to learn. Those are the things I normally use it for. I don't use it for anything else, because if you do, it's not really going to serve its true purpose. So those are the main three things I like to use it for. With the life insurance policy, there's a lot of ways you can get creative. So what you can do here is say you go get a car. And let me go ahead and just share my screen so we can just go over it together. So let's say over here, draw a nice little line. Well, I shouldn't say nice. I'm not the best drawer, so forgive me for that. Draw down the middle. Let's say you want to use the bank for your car. And oops, as you see, I can't draw the best. That's okay. Let's say the car is going to be $15,000. I'm going to borrow 15 from the bank. Don't judge my 5. 15,000. As you see, those are probably the ugliest circles you ever seen in your life. Let's say the car payment is $250 a month. So $250. And remember, I'm paying this back to the bank, right? I'm never going to see this money again. Let's go over here to life insurance. Let's put LI. Let's say we're going to put CV for cash value. So CV. Let me erase that real quick. Try again. Let's do CV. Let me just type it out. Oh, there we go. CV means cash value. That's how much I have in my policy. Let's say I have $15,000. Actually, let's say 17. I have 17,000. Because you only can borrow 75 to 9% when you have your policy. So let's say I'm going to borrow 90% of this. Let's come down here. So I borrow from my life insurance policy. I'm going to earn 3 to 5% dividends still in the policy. So this number here is still going to grow. And when I borrow from the policy, I'm going to pay myself back that same 250 for the car payment. Only difference is that instead of it going to the bank, it goes back to myself. And what I do is once I'm done paying it off, and yes, I have 1 to 3% interest I got to pay each year. That money is growing at 3 to 5% every single year. And then when I'm done paying off my car to myself, I get to use that capital again, but at a higher rate, because I'm still saving in this policy. It's still growing at 3 to 5%. And I get to keep my money. If I'm over here with the bank, and I'm paying them 250, I'm never going to see that money again. I'm just giving them money, right? But let's just also say you're saving for a car, right? You're saving in the bank. And as soon as that money's pulled out, it's gone forever. You only earn 0.1% in the bank. So you're not earning anything if you keep your money in the bank. But when it comes to consumerism and you're buying a car, obviously, you need a car. We all have to have something to drive with. So what's going to be the best way to go about buying your car? Well, you want to use a life insurance policy because, again, when you do this the right way, and you also not only save yourself by not having to use the bank, but also you save on interest because what people are paying, can pay up 13, 17% on interest. People might pay 4, depending on your credit. That is a possibility. But at the end of the day, you don't get to keep your capital if you're putting it towards the bank. You just won't. That money's gone forever. Whereas we have a life insurance policy, you borrow and you pay yourself back. That money can be used again, which is a great thing. And the only thing I'm going to pay is 1 to 3% interest every year. So I would much rather save my money in a place where it's going to grow every year. Also, I get to use it again instead of putting it towards an institution that, one, they're going to make money off of me. Two, I'm never going to see that money again. And three, I pay higher interest possibly. So this is the next step when it comes to financial freedom. Again, if you haven't already, make sure you pick up the book by Jerry Fetta, The Blueprint to Financial Freedom. That's where we get all these concepts from. And if you want to go see my previous video where I talk about, setting up different insurances so you can be properly covered, make sure you go check out part 4. And make sure you also leave a comment, like, and subscribe. And I'll see you in the next video.